Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage, and welcome to another edition of Java with Jared. Hope you guys are doing fantastic. Well, happy Friday. Actually, happy Good Friday, that is. The markets are closed here this Friday in observance of Good Friday and anticipation of the Easter weekend on Sunday. So hope you guys have a very wonderful week. Well, last week we saw interest rates improve, and this week interest rates actually got worse. And we saw interest rates improve last week because the stock market actually took it on the chin and suffered, and we saw money flow from stocks into mortgage bonds and mortgage-backed securities. And I was mentioning would be interesting to see if we saw stocks continue to decline and interest rates benefit from that. Well, that didn't happen. Actually, stocks found their footing on Monday, and this week it was interest rates turn to lay an egg in observance here of Easter. So interest rates got worse this week because the stock market got better. In terms of economic data, we saw the consumer price index come in, and that's showing a little bit more inflation. Just as a PPI number, the producer price index showed that there was actually more inflation than what these numbers previously had indicated. Consumer price index came in with a 0.2% increase on both the core and the headline number, again showing that there's a little bit more inflation, and inflation is typically bad for interest rates because it shows that the economy is improving and things are costing a little bit more, and that usually requires a little bit higher yield for investors when they're investing in mortgage-backed securities. So that is why that happens. But we're seeing a little bit more inflation than what we previously had seen. It's not anything severe. It's not huge. It's actually still below what the Federal Reserve is trying to do, but at least there's a bit of a trend, and so that's one of the reasons that interest rates suffered a little bit. We also saw some information come in from the housing sector. We did see the Home Builders Survey come in. That showed a number of 47. Expectations were for 50, so not really a bad number, but not quite as good as expected. We also did see that the housing starts came in showing a 3% increase. So both, just pretty good numbers on the housing side, just kind of slow and steady numbers, nothing huge, and nothing showing that the housing sector is really doing poorly or doing great. It's just, kind of a good number. So the biggest news, though, was the Philadelphia Fed index, and that's what caused stocks to really advance here on Thursday, and actually mortgage-backed securities and interest rates really suffer. The Philadelphia Fed index measures economic activity in that region, and that showed almost a double than what was expected, showed a number of about 16, and it was expected at about 8. So that caused interest rates to suffer because the stock market really rallied. And so we're basically back to where we were. All the gains of last week translated in losses of this week, and so we're back where we were about 2 weeks ago. But interest rates are still fantastic. So hope you guys have a very wonderful week. Next week we're going to see some more information come in from the housing sector. We're going to see it's going to be pretty heavy. We're going to see new home sales and existing home sales, and then we'll also see durable goods. So hope you have a very wonderful weekend. Hope you find some eggs here on Sunday, or your kids, maybe a little candy. Have a wonderful, wonderful Easter Sunday. And if you are working, so are we. Give us a call, and I hope you have a very wonderful Easter. Talk to you later. Bye-bye.